This particular problem we are dealing with in terms of computation of value created by new strategy. Whether a new strategy proposed to be implemented by a company would be beneficial or not. That is what we are going to calculate here. So the given question runs like the income statement for 0th year, that is the year which has just ended at the beginning of that year, and the balance sheet at the end of year 0 for Megastar Limited are as follows. See opposite you see income statement and balance sheet have been given. What do they say? Income statement says sales 2 lakh, gross margin 20% of sales, that is 50,000. Selling and general administration expenses extra. So now the question further reads, Megastar Limited is debating whether it should maintain the status quo or adopt a new strategy. If it maintains status quo, sales will remain at 2 lakh. Gross margin will remain at 25%, and the selling, general and administrative expenses will be 10% of sales. Depreciation charges will be equal to new investments. The asset turnover ratios will remain constant. The discount rate will be 15%. The income tax rate will be 33%. If Megastar Limited adopts a new strategy, its sales will grow at the rate of 30% per year for 3 years. Thereafter, sales will remain constant. Margins, the turnover ratios, the capital structure, the income tax rate, and the discount rate, however, will remain unchanged. Depreciation charges will be equal to 20% of the net fixed assets at the beginning of the year. After 3 years, capital expenditure will be equal to depreciation. What value will the new strategy create? That's the question. Now, how we would go about doing this is, we are marking here particulars, income statement, projection over years 1, 2, 3. What is given firstly? Sales 0.25% is the growth rate. So current year is 2 lakhs. Now first year it will be 2 lakh 50,000. Second year it will be 3 lakh 12,000, and third year it will be 3 lakh 90,625 by multiplying with 1.25. Gross margin will increase by 0.2%, isn't it? So for current year it will be 50. That is 0.2 into 2 lakh 50,000. For first year it will be 60,000. Second year 72,000. Third year 86,400. Selling and general administration expenses 0.1% of sale, that is 20,000, 25, 31, 39, like that. Profits before tax 25%, 0.25%, 0.25 or 25% of the sales value, that is 43,000. Is going the profit before tax is growing by 0.25%. Given is 43 for the current year, so it will grow to 53,750 in first year, and this is the value given in the zeroth year. No, so first year 53, second year 67, third year 83. Tax rate is also growing by 25%. Given is 14,190, and it will grow to 17, 22, 27, like that. Profit after tax also will grow by 25%. So subtracting the above 2, you will get 28 something. Here 36, this here 45, here 56. Balance sheet projection, similarly, when we do here in the balance sheet portion, you would see equity 2,50,000, fixed asset 1,50,000, current assets 1 lakh. So total 2,50,000. So its projections will be, again, fixed assets growth rate is 25%. Given is 1,50,000, it will become 1,87,000, 2,34,000, 2,92,000, like that. And current assets given, again, growth rate is 25%. Given is 1 lakh, it will become 1,25,000, 1,56,000, 1,95,000. So total 2,50,000, which will be growing into 3,12,000, 3,90,000, 4,88,000 like that. Similarly, liabilities, equity growth again to 0.25 or 25%, 2,50,000 is given. It will become 3,12,000, 3,90,000, 4,88,000 like that. So profit after tax again growing. What we are taking it out now, the cash flow projections we are calculating here by taking out the profit after tax which we have calculated above, and we will add the depreciation value with that. Depreciation is also given as 0.2% growth, and we will subtract the capital expenditure. We will subtract the increase in current assets, so we will get the operating cash flow as this value. And present value of the operating cash flow by incorporating the present value multiplication factor in terms of the returns expected, that is whatever is given, the value below. So what is given is H34. At H34, what is given? What is given is 0.15%. The discount rate will be 15% is given. So with that, we calculate the total present value of operating cash flow for 3 years of projection, and we add it up, we will get 31,298.78. That's the operating cash flow. Now, the residual value is profit after tax of last year divided by R. So that is F19, when you look at it, profit after tax of last year, 56,269.53, which we have calculated, divided by the expected returns, 1 plus expected returns to the power of expected returns we are just subtracting by 0.15, dividing by 0.15. So residual value is equal to part of last year divided by R. Present value of residual value is equal to residual value into 1 plus R to the power of n. That is the present value multiplication factor, PVIF. So then we get out of 37,000 plus, we get 24,000 something. So total shareholders value will be present value of residual value plus present value of operating cash flow. Present value of operating cash flow. So this value and the value we calculated earlier, present value of operating 31,298 and 24,6654 will become 2,77,952.98. What is the so this is the post strategy value for the company calculated. What is the pre-strategy value? Pre-strategy value is the PAT star divided by R. What is PAT star? PAT star is at C19. What is at C19? That is the current years or the 0th year's profit after tax divided by return expected or the cost of capital. Then we will get 1,92,000. So value of strategy will be post strategy value minus pre-strategy value, or shareholders value as we have calculated earlier, from which we subtract the pre-strategy value we have found here. That is 2,77,000 minus 1,92,000 something, we get 85,886. So this being a positive value, we are saying that by implementing the strategy, recommended strategy, the company is adding value. So this thing can be recommended.